A retired man walked into the bank he'd trusted for over 2 decades, asked to take out $22,000 of his own savings, and left with his entire account locked. For 19 straight days, he couldn't access a single cent. No crime had been committed, no fraud was under investigation. He'd done absolutely nothing wrong, and the bank was entirely within its rights to do it anyway. If you're 65 or older, this could happen to you this week. And almost nobody has warned you. Stay with me, because there's one phone call that prevents this before it ever starts. I'm Lana Maines. If this channel is new to you, go ahead and subscribe and turn on notifications right now. Every week, I break down the financial rules that hit seniors directly, the changes, the protections you're already entitled to, and the moves that genuinely matter. This is the kind of thing I put out weekly, and you really don't want to miss it. Let's get into it. Gerald, what 19 days of frozen money looks like? Meet Gerald. He's 67, a retired middle school principal from Dayton, Ohio. Same checking account at the same regional bank since 1999. A pension, a home with no mortgage, and about $41,000 sitting in that account. On an otherwise unremarkable Tuesday, he walked in and requested $22,000 to help his son avoid losing a house to foreclosure. A compliance flag popped up. A manager materialized. Gerald was guided into a private office and asked a series of questions. Who is this money going to? Has anyone contacted you recently asking you to move funds? Have you met someone new online? A 67-year-old retired educator with an immaculate financial record was being interrogated about whether somebody had coerced him into helping his own child. 2 days later, the withdrawal was placed on hold pending review. That review lasted 19 days. Gerald did nothing wrong. The legal framework. Your bank won't explain. Here's the legal structure that made it all possible. More than half of U.S. states have enacted laws that permit financial institutions to impose temporary freezes on accounts held by customers who are 65 or older. The stated purpose was elder fraud prevention. The real-world outcome is that a bank can legally lock your funds for 14 to 15 business days, roughly 3 weeks once weekends and holidays are counted, without a court order, without proof of fraud, and without your consent. All the bank needs is a compliance trigger and your age. The trigger doesn't have to be criminal or even traditionally suspicious. It just has to match one of the patterns the institution's monitoring software is programmed to catch. Why this shifted now? For most of banking history, if an institution delayed a customer's transaction without justification, it could be sued. Banks had very little legal protection to interfere, even when something felt off. As elder financial exploitation losses climbed into the billions every year, state legislators responded by granting banks safe harbor protection, meaning a bank cannot be held liable for freezing or delaying a transaction if it reasonably believed an older customer might be a target of exploitation. That single legal change is what converted a teller's gut instinct into a 19-day lock with zero consequences for the bank. The specified adult reclassification. It's worth pausing on the specific language these statutes use, because it explains why this rule feels invisible right up until the moment it isn't. Most of these laws refer to a specified adult. That category is almost universally defined as anyone 65 or older. Sometimes alongside adults, the bank has independent reason to consider vulnerable regardless of age. The day you cross that birthday, you're quietly reclassified inside the bank's compliance system. Nothing about your behavior, your judgment, or your account history has changed. No letter arrives announcing the reclassification. You simply discover it the day a transaction that would have sailed through the previous week suddenly doesn't. That brings us directly to the 6 triggers, because any one of them can activate a hold on your account today. Trigger 1. Unusual withdrawal amounts. If your typical monthly withdrawals hover around $800 and you walk in requesting $15,000, the software flags the deviation draw regardless of your reason. What to do? Call the bank 48 hours ahead for any withdrawal that falls outside your normal pattern. State the amount, give a one-sentence purpose, and ask the branch to log it in your account record before you arrive. That single call turns a flag into a documented expectation. Trigger 2, new or unfamiliar. Payees, a wire transfer, a cashier's check to an out-of-state title company, a Zelle payment to a contact you've never sent money to above a certain dollar amount. All of these can trip the system. What to do? Before initiating any new payee transaction above $5,000, confirm with the bank by phone or in writing. Keep documentation that explains the transaction, a bill of sale, a closing disclosure, a letter from an attorney. One document shifts the classification from unexplained to explained. Trigger 3, employee observations. A teller who notices confusion, an unusual demeanor, or a third party coaching you through a transaction can file an internal report that activates a hold with no dollar threshold attached. What to do? Never bring a family member into the transaction area if that person isn't a named account holder. If someone drives you to the bank, they wait outside. Your composure and your independence are part of your documentation. Stop here for a moment. Open your bank app right now and look at your last 6 transactions. Ask yourself whether any amount would stand out as a break from your previous 6 months of activity. If you can spot the pattern break, the bank's software already has. Trigger 4, the $10,000 federal reporting line under the Bank Secrecy Act, Title 31, U.S. Code. Section 5318, any cash transaction above $10,000 requires the bank to file a currency transaction report with the Financial Crimes Enforcement Network. Your name, social security number, address, the amount, the exact time. You will never see a copy. The bank is legally prohibited from telling you it was filed. In states with elder hold legislation, this report on a customer age 65 or older can independently activate a hold review. What to do? If you're depositing or withdrawing a large amount of legal cash, bring documentation explaining the source before you reach the window. Walk in with the paper trail already in your hands. One critical note here, because I see this mistake more than almost any other. Do not respond to the $10,000 threshold by splitting a withdrawal into smaller pieces to stay under it. That is called structuring, and breaking up transactions specifically to evade the federal report is a separate criminal offense, regardless of whether every dollar is entirely legal and entirely yours. The safest approach is always one clean transaction with documentation, never a series of smaller ones engineered to dodge the report. I've watched this single misunderstanding inflict more damage than the original large withdrawal ever would have because a structuring flag doesn't resolve in 19 days. It can set off a far longer federal review, all because a senior was trying to be careful and made things worse instead. Trigger 5, beneficiary changes and address updates. A beneficiary update or change of address filed close in time to a large transaction. The software cross-references timelines. A new beneficiary added on Monday and a $20,000 withdrawal requested the following Friday reads as a pattern, even if the two actions are completely unrelated. What to do? Separate these actions by at least 30 days when possible. If the timing can't be separated, call the bank in advance and note both actions in your account record so they appear deliberate rather than sequential and suspicious. Trigger 6. A family member's concern. A family member or caregiver who contacts the bank independently and raises a worry. A well-intentioned adult child who calls and says they're concerned about their parents' financial decisions has just activated the compliance framework without any specific allegation of wrongdoing. The bank doesn't need to investigate. It only needs to log the concern. You'll see exactly how to neutralize this one in the next section, because it requires a structural fix, not just a conversation. Why banks face no penalty for freezing your account. Those are all 6 triggers, but knowing what fires the gun is still a reactive position. Here's the part that should stop you cold. Your bank is not penalized for freezing your account incorrectly. No fine, no regulatory action, no legal consequence for a bank that holds your funds for 19 days on a trigger that turns out to be absolutely nothing. The consequences run entirely the other direction. A bank that fails to act when a trigger is present can face regulatory sanctions, civil liability, and federal investigation under elder financial exploitation statutes, active in more than 30 states. Freeze first. Investigate later. Apologize if at all. That is the entire incentive structure. The bank is not your partner. It is a compliance organism optimized to shield itself from liability. Your 19 frozen days are not a malfunction. They are the system working exactly as it was built to work. The only person in that system with a structural reason to prevent the freeze is you. The one call that changes everything. That brings us to the call that shifts your position entirely. It costs nothing. It takes under 15 minutes. There's no fee, no product, no account minimum. And it creates a legal paper trail that applies to every transaction in your account, regardless of size. The call is to your bank's Elder Services Department, account protection line, or, if neither of those exists, the branch manager directly. You're requesting two things in one conversation. First, ask to place a trusted contact person designation on your account. Under Financial Industry Regulatory Authority, Rule 4512, effective since 2018, financial institutions are required to allow customers to name a trusted contact. This is not a power of attorney. It does not authorize anyone to access your funds. It designates a person the bank can reach out to before initiating a hold, someone who can confirm your acting of your own free will. That designation legally shifts the bank's first step. They must contact your trusted contact before a hold is placed, not after. Second, request that a standing transaction authorization letter be placed in your file. A written statement describing your normal transaction patterns and authorizing the bank to treat activity within those parameters as pre-approved. It doesn't eliminate compliance reviews for genuinely unusual activity. It eliminates the automatic flag for activity that's normal for you but looks abnormal to software that has no context. That one call, trusted contact designation plus standing authorization letter, directly addresses 5 of the 6 triggers. The 6th, the family member who calls in a concern, is handled by the designation itself. If your trusted contact is already on file and confirms your clarity and intent, the bank has a documented response to any outside concern filed against you. Here's the catch. This designation is not retroactive. It applies from the moment it's filed. A freeze initiated before the designation is in place will not be reversed by it. The call works only if it's made before the trigger fires. A resource. You should grab the exemptions, the deductions, the refunds. Most seniors already qualify for these but never claim them. I've compiled everyone into a single resource, organized state by state and form by form, so you're not spending hours lost in government websites. It's all laid out simply so any retiree can pinpoint exactly what applies to them. No matter where you live, there's money you're walking away from. It's called the Senior Exemption Playbook, and it's in the first pinned comment directly below this video. One tap, and it's yours. Now stay right here, because the last layer I'm about to give you is the biggest protection most seniors never put in place, and it's the reason I recorded this entire video. 2 backup layers that close the remaining doors layer. 1. A durable financial power of attorney filed directly with the bank, not notarized and stored at home, not held in your attorney's desk drawer, filed with the bank, acknowledged in writing, and attached to your account record. Under most state statutes, a durable power of attorney on file creates a second mandatory checkpoint before a hold can be extended beyond the initial review window. Without it, the bank's compliance team operates with no external accountability. With it, there's a named individual with legal standing to intervene on your behalf. It's worth being specific about what durable means here, because that word is doing real legal work. A standard power of attorney can become invalid the moment you're deemed incapacitated, which is precisely when you'd need it most. A durable power of attorney is drafted to remain in effect through incapacity. If your existing document doesn't specifically include durability language recognized in your state, the bank may treat it as expired at the exact moment your family is trying to use it to unfreeze your funds. Layer 2. A written baseline transaction record submitted to your bank annually. 1 page. Your name, account number, a brief description of your normal financial activity, monthly withdrawal range, recurring payees, typical transaction frequency. Signed, dated, and filed with the branch manager. This document gives the bank the context that turns a flag into a non-event. It's also worth knowing that not every bank handles this the same way, so ask specifically. Some institutions only offer a trusted contact designation on brokerage or investment accounts, not standard checking. If your branch tells you it isn't available, ask for that response in writing. And if they still say no, that's worth escalating to your state's banking regulator, because FINRA Rule 4512 applies broadly across most regulated financial institutions. Gerald had none of these three things in place: no trusted contact designation, no durable power of attorney on file with the bank, no baseline transaction record. He had a 24-year banking relationship, a spotless history, and zero protection on the day the compliance system decided his withdrawal looked unusual. He got his money back on day 19. You don't have to wait 19 days. Your 6-step action plan. Step 1. Call your bank today. Ask for the Elder Services Department or Account Protection Line. If the representative doesn't know what a trusted contact person designation is, ask to speak with a branch manager. FINRA Rule 4512 is a federally recognized requirement. Use that phrase. Step 2. Name your trusted contact before you hang up. This is the person the bank calls before placing a hold. It can be an adult child, a sibling, a trusted friend, or your attorney. Get written confirmation that the designation was recorded. Step 3. Request the Standing Transaction Authorization Letter form. Describe your normal monthly activity honestly. Sign it, date it, keep a copy. Step 4. Bring your durable financial power of attorney to the branch in person. Don't mail it. Hand it to the manager, watch it get logged, and ask for written confirmation that it's attached to your account record. Step 5. Set a calendar reminder to review and resubmit your baseline transaction record every January. A record from 4 years ago doesn't protect a transaction pattern that looks different today. Step 6. Tell one person you trust that you made this call. Not because you need their permission, because the strongest defense against the family member trigger is a family that already knows your financial decisions are deliberate, documented, and on file. Your money is yours. One call made today makes sure the bank is legally required to remember that before it touches a single dollar.